battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 42, going on 43 years, it's been our mission to deliver both clarity and confidence to help secure your financial future. Welcome back. We have taken a brief hiatus, took a couple weeks off, been on the road traveling, seeing many of you, our ExxonMobil families, Conoco families, Chevron, a couple other people down in the Houston area. And then I went out to North Carolina, spent some time with some clients down there. So I am back. I am ready to go. I got out of the cold weather for a few weeks, so that is always a good thing. But it's getting nice here in Chicago. Episode 141, about to be March. Hard to believe. We're rolling right up to our big events. Before you know it, we're going to be at the Gibson's Steakhouse in Oak Brook. You've joined us there before for a Wealth Insights Forum. This year, a little bit different, very exciting. We're actually going to do a live podcast on stage, so don't miss that out. Don't miss that, and get that on your calendar. We're actually going to have Jeremy Schwartz. That's the speaker. I couldn't announce it a couple weeks ago, but now I can. It's all locked in. Jeremy Schwartz. He was Dr. Siegel. If you've heard Dr. Jeremy Siegel with us at the Wharton School, his star student. Unbelievable. The guy's just a phenomenal speaker, really good at podcasts, and he is also a co-author on Stocks for the Long Run, the most recent edition with Dr. Siegel. He's the head of research at Wisdom Tree Asset Management. Don't miss it. Get that on the calendar. April 17th, coming up in about 7 weeks by the time you watch this episode. And then a week later, we follow that up with a Houston Wealth Insights Forum. We're going to be at Trulux on April 24th. Get it on the calendar. We can't wait to see you. We're going to bring most of the team down. All of us will be at April 17th at Gibson's, and then Trulux, the Woodlands, April 24th. Get it on the calendar. We can't wait. And that's some of our best stuff that we bring you each and every year. So come out to those events. All right. Jumping right in here, episode 141. Is this a bubble? My short answer is no. And if you're going to stop the podcast, pause, exit out of Spotify or YouTube, and not watch anything else for the rest of the show, that's okay. I hope you stay with us. But I will tell you, I do not think that we are in the middle of a stock market bubble. And the doom and gloomers have been saying this for years now. They say this each and every year relentlessly, that this is the one that's going to take us out, that stocks are overvalued. I do not agree. I do not think that's correct. Part of the reason why is simply because everybody's saying we're in a bubble. And surprise, surprise, let you in on a little bit of inside baseball here. You don't have a bubble, or it's typically not a stock market bubble when everybody thinks it is. It's usually a bubble when nobody expects it. We had a bubble in 2021, and I will give the Bears that bubble. They did say that 2021 was a bubble. Now, I will say many of them said that stocks could keep going in 2021. We said the opposite. We said the market had run up a little bit too fast and that we probably would hand some back. Now, I will say I did not expect us to hand back as much as we did in 2021. Pretty significant correction. But my point is we're not in a bubble when everybody says we are. We're in a bubble when nobody expects it. And I just don't see that today. There's so much cash sitting on the sidelines. Even if we see bankruptcies, which I do think are coming, even if we see commercial real estate problems, which I do think are coming, even if we see layoffs, even if we see all the doom and gloom things that the gloomers have been talking about, there is so much dry powder on the sidelines. There's so many unfilled jobs. There's so many people waiting for a buying opportunity that even if we do have a correction, I think it's coming at some point this year, it's going to be short-lived. There's so many people waiting to get in. The doomers have been waiting for a redo of 1999. And that is the one incident, one time in history that haunts the bulls And it's haunted us for 25 years now, the fact that during 1999, during 2000, there was a bubble in the stock market. Now, if you're on a goals-based plan, if you were like our clients, you weren't over-allocated to tech, you survived. You made it. Obviously, you saw your portfolio correct in the tech bubble, but you didn't get wiped out because you had diversification, you had different sectors, you had different companies, you didn't have everything, all your eggs in one basket, all your eggs in one stock, and you were fine. But the reality is a lot of people went into 1999 and 2000 very, very optimistic, very, very bullish. Kevin Hassett, who served under the Trump administration, wrote a book. Can't remember the co-author, but they wrote a book in 1999 called Dow 36,000. And it took, he was right in the long run, but in the short run, he was very wrong. That was basically the peak of the market in when he wrote that book in the 90s. And the Dow did not hit 36,000 for about 2 decades. So yes, right in the long run, Kevin, wrong in the short term. But the reality is if you rebalanced, if you held on to your stocks, if you got into, if you did some rebalancing along the way, you took some profits, you bought some of the stuff that was down, you did fine. You were buying Amazon when it was on sale. It was down 97%. You bought Microsoft when it was on sale. And if you held on until now, you saw stocks hit record all-time highs just this year. So the record all-time high in the S&P now is 5,100, not a whole lot higher than it was in 2021. Market traded about 4,750 in 2021. So we're only a few percentage points higher than we were a couple years ago. A lot of people are going to say, look, Nick, the market hasn't done anything in a couple of years. We haven't really made any money. And that is partially true. If all you did was hold and you didn't ever rebalance, you didn't buy more when things were cheap, that is correct. But think about in actuality, if you had a portfolio manager like us rebalancing you along the way, you were buying in 2022 when stocks were on sale. You were buying in 2023, especially last fall when stocks were on sale. And so here you are today. You've got some money that you're flat on or up a little bit. You've got some money you're up a lot on from the stocks you bought in 2022 at lows. And then you got some money you're up even a little bit more on, which is from the lows of 2023 last year. And so remember, the S&P traded at 4,400 points in October of 2023. I wrote that article, Bye Bye Baby, telling you to do what? On a goals-based plan, allocate more money to stocks because they look cheap. And sure enough, they were. Here we are a couple months later, market's at 5,100. So haunting the bulls the past 25 years has been the tech bubble. I do not think we're in a tech bubble today. The big comparison to the late 90s, of course, is Cisco and NVIDIA. NVIDIA is the big hot stock today. Well, Cisco was the big hot stock in the 90s. And Cisco in the 90s traded at astronomical levels. And it was trading right around 150 times earnings. For comparison's sake, NVIDIA only trades at 40 times earnings today, which is high. It's double what the stock market trades at, but it's not 150. So could you see a pullback in NVIDIA stock in the short term? Sure, absolutely. It's probably coming at some point. But I think more likely than not, NVIDIA stock is actually fairly valued, and I believe at some point could become undervalued and actually a reasonable buy. So I'm not buying this narrative on NVIDIA. I don't think NVIDIA is in the same spot that Cisco was in the 90s. Certainly it could get there. If NVIDIA ever did trade at 150 times earnings, I would be on the show every week saying, hey, caution, 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 be a little bit careful there. And by the way, there are stocks that are trading at 150 times earnings right now, 200 times earnings, 250 times earnings. I would never touch. I wouldn't touch unless they got back into a more reasonable zone. You're going to see companies like that in this bull market. We are in a bull market. You're going to see companies that are going to trade at those levels, just like you did in 2021, just like you did in 1999, that you'll probably never see a return on for the next 10 years. You may see a return down the road, but technology moves very quickly. You got to be careful how much you pay for those earnings. My general consensus, my view of the overall market, though, is that most stocks are not in that bubble. Yes, there's some companies that are, but most companies are actually pretty reasonably priced. In the late 90s, it was all about multiple expansion. So earnings were flat. They were stagnating. Companies really weren't making a whole lot more in profit each and every year. But if you looked at their stock prices, they were going from 20 times earnings to 40 to 60 to 100 times earnings. It was all about multiple expansion. The opposite is true today, literally the opposite. Yes, we've seen some multiple expansion, of course, on some of those names. But if you go back 5 years and you look at Microsoft, you look at Apple, you look at NVIDIA, you look at Amazon, you look at Google, Netflix, Facebook, all these big stocks that everybody says are in a bubble today, their price to earnings ratios on a go forward basis are right in line with their 5 year averages. And in fact, some of them are actually cheaper today than they were 5 years ago with all the extra cash, with all the extra earnings, with all the extra profitability. And the way you know this is true and you can test this is by looking at their balance sheets. These companies are sitting on stockpiles, war chests of cash. Where did they get the cash from? They didn't just print it like the Federal Reserve does. They made it in profit. And you saw Berkshire Hathaway just came out, not a tech stock, of course, not a big tech company, but they own a lot of Apple stock. They're sitting on more cash than ever before. Warren Buffett doesn't know what to do with it. They've got so much of it. They're earning more on their cash than a lot of companies even make in revenue. So the reality is these companies are just not in this Fugazi environment like we were in 1998, 1999, and 2000. Today, companies have really strong balance sheets. Consumers have strong balance sheets. 40% of homeowners do not have a mortgage. That's right. You heard that correctly. 40% of homeowners do not have a mortgage. Of the group that does have a mortgage, 64% have under a 4% rate. So people are just not having the financing issues that we had in 08 and 09. Some of the bad lending's coming back. Some of the credit card debt's coming back. Some of the student loans are a cause for concern. But the baby boomer generation that holds most of the wealth in this country, they're older, they've worked longer, they've invested for longer, they have most of the wealth. They're going to pass that wealth down the next 10, 15 years. And the reality is the baby boomers are very strong. They're typically debt free. They have lots of cash on their balance sheet. They're going and spending and they're traveling or they're stimulating the economy. That's a wonderful thing if you're a stockholder, especially in luxury goods. You've seen luxury stocks just take off. Ferrari, I'm not telling you to go buy the stock, but Ferrari is up like a crazy amount the past 5 years. Louis Vuitton is up a bunch the past 5 years. All these big luxury stocks have just taken off. Why? Because consumers are spending money. Same thing with companies. Companies are doing just fine. Now, what do companies spend their money on when they have a bunch of cash? They issue dividends, they do buybacks. That's where you buy your own stock back. And yes, I know the people like Elizabeth Warren are very upset with them for doing this. It's ridiculous. It's not true. There's even Republicans who are upset with them for doing this. That's crazy. Buybacks are not a bad thing for a stock. If you think your stock is cheap, you should buy it back. That's a corporate buyback. And if you're a stockholder in one of these companies that's processing buybacks, you should love it because the outstanding shares are reducing and therefore the earnings per share is going up. Apple's done this the past 10 years and it's been a wonderful thing for shareholders. So you got buybacks, you got dividends, and now M&A. And I think M&A has been in this valley, this trough for the past couple of years since interest rates have gone up. M&A is going to come back in a big way. And if the Fed cuts 1% or 2%, even some companies are sort of coming to grips with the fact that, you know what, higher rates are here for longer. They're here to stay. They're going to adjust to the higher interest rate environment. Companies are going to buy other companies. That's just what they do. And so we are living in a time where I think even if we do have a pullback, which we probably will, it's going to happen at some point. Again, I think it's going to be short-lived, and you may not have time to react and get in because it could be just a small blip on the radar like they usually are. Now, in the late 90s, I'll just take 1 second to say, just like Cisco traded at 150 times earnings, the broad S&P, so all 500 companies on average, traded at 40 times earnings. That's a lot. Today, they only trade at 20 times earnings. So if you did the same math and you went back to the 90s and you took that 40 times earnings and you applied it to earnings on the S&P today, we would be trading the S&P not at 5,100, but rather at 9,700 points. If the S&P was 9,700 points today, I would tell you this is a bubble. You should be a little bit nervous. You should be a little bit cautious, taking some profits. We're nowhere close to that today. And in fact, I believe in a lower interest rate environment. Again, if the Fed cuts 1%, 2%, wherever we ultimately end up, we'll probably end up back at those longer term 3%, 2.5% 10-year treasury rates. I believe the S&P could easily trade at 25 times earnings. We're going to get a lot of earnings growth the next couple of years from AI, machine learning, the cloud, all the great technology that's going on. And what you're going to see is stocks are going to continue to rise. I believe that 2024 already been a good year for stocks. I think you're going to be surprised, and we're going to see stocks keep going up before they go down. So don't be alarmed by this. Don't be surprised. We're not in a bubble. We could get there, but we just aren't there yet. Stocks are not cheap today. I do want to make that comment as well. Stocks are not undervalued like they were in 2022 and 2020 with COVID, 2015, 2011, or 2008, of course, but they are fairly valued. So we're sort of in this middle zone. There's three classifications that we have assigned to a company or to a market. We'll say overvalued, fairly valued, undervalued. We're not in undervalued today. We're not in overvalued. I believe we're in fairly valued. And so what could happen, just like what happened in the 90s leading up to the tech bubble, is we could see stocks stay at fairly valued for a while and slowly start marching up towards overvalued. Nobody knows for sure. Nobody has any idea exactly what's going to happen here, but that's exactly what you saw in the 90s. You had 1991, 92, 93, 94, 95, 96, 97, 98. Almost all those years were positive, face ripper, melt your face off years, up 20, 25, 30% years. You could have that this time. I don't think it's going to happen. I doubt, because we learned from our mistakes in the 90s that was too much to pay for a stock. I don't think we're going to make the same mistake twice in the stock market. It's very rare, but it is possible you go from where we're at today, 20 times earnings, to 21 or 22 or 23 or 24 or 25. That stock market run could last 5-6 years. And if you sit that out because you think stocks are overvalued right now, which I don't think they are, you could miss out on this massive, massive run the next 5 years. Eventually, let's just say earnings don't catch up, which I think is unlikely, but let's say earnings don't catch up the next 5 years, but stock prices go up. Then you could enter overvalued territory and have a big bubble pop. But you got to stay invested the whole time. I know it's not an easy answer. I know it's not the answer you want, but it's the answer you need. And that's the fact that you got to stay invested throughout the whole cycle. Unless you have a crystal ball and you're sitting there looking at it, trying to read and say, ooh, the market's going to go up next year and it's going to go up the year after that, but then it's going to go down. So I'll get out and I'll short and I'll buy and I'll sell. Nobody can do that. You show me one person who has successfully been able to time the market over the long run, and I'll show you 100 who have not, who have lost their shirt trying to time the market, trying to get fancy. Look at all the hedge funds who don't make any money, right? They charge you 2% on your assets plus 20% of your profits, 2 and 20. They haven't made money in 10 years by being bearish. And so you can't do that if you are on a long-term goals-based plan. You just got to stay the course. And it's an easy answer. They're not going to put me on CNBC and say, hey, Nick, what do you think? What am I going to do? I'm going to go on CNBC and say everything's fine, just buy and hold for the long run. Boring. Everyone's going to turn it off. They're going to go to the next channel. They got to put the people on TV who are going to tell their audience the sky's falling. The media loves stuff like that. They love telling people that the world is coming to an end. And I just don't believe it. I don't think that that is good fiduciary advice. I think stocks are going to go up over time. I think the stock market's fairly valued today, and I do believe that over the next, call it year, 18 months, we're going to see stocks pretty darn close to 5,800, 6,000 points. I don't think that would be radically out of the question here. So part of the optimism today, of course, is the belief that Powell is going to cut rates. I don't know if he cuts as much as people think this year. Definitely next year, 2025, I could see some cuts, definitely by 2026. But because rates may not go down as fast as people would like or as fast as they probably should, in my opinion, we could see that create some stock market volatility. That correction is going to come. Just be aware of it. Don't react to it. Don't panic, but just remember this show. Remember what I'm telling you. I'm going to do these as much as I can leading up to the correction to remind you that correction's coming. Don't panic. So stay the course. You know the correction's coming. Don't get out of the market. Now, I do want to just point out the fact there is this gentleman, Michael Sembalist, who is one of the top investment guys at JP Morgan. Just tremendous. I mean, this guy is usually spot on. I don't agree with everything he says, but one of the things that I do like that he talks about is he does this Armageddonist update. And what he writes, he's got this weekly or monthly article called Eye on the Market he publishes. I'm just going to read you the paragraph here. He says, one of my guilty pleasures, highlighting the track record of the Armageddonists that the media flock to for comments on the impending disasters always facing investors. I first wrote about this Legion of Doom in 2019. From 2011 to 2016, these pundits each proclaimed at some point that the sky was falling. We computed the returns investors would have missed out on by switching from stocks into bonds when their predictions occurred. The resulting underperformance ranged from 30 to 60% by the end of 2019. So let me just summarize. This is what Michael did, and this is hilarious. This is great. I think this is phenomenal. You guys know we have the doom and gloom folder here. But what Michael Sembelis did at JP Morgan is he tracked all the doomers, all the people that said the world was coming to an end, 2011 to 2016, 2019. And then they tracked returns if you held your stocks, and then when they said the world was coming to an end, you went to bonds. You lost 30 to 60% by listening to the doom and gloomers. He even takes it a step further, and he brings up a couple of the big ones here. Here's Peter Schiff, March 25th, 2020. Peter Schiff, what the Fed is doing is extremely bearish for the U.S. economy. It ensures that this depression that we've entered is going to be extremely brutal, and the inflation that is going to ravage the economy, particularly investors and retirees. Here's Jeff Gundlach. He's one of the big guys, bond manager at Double Line Portfolios, March 31st, 2020. The low we hit in the middle of March, I would bet that low will get taken out. The market has really made it back to a resistance zone, and the market continues to act somewhat dysfunctionally, in my opinion. Take out the low of March, and then we'll get a more enduring low. Spooky, doom and gloom. Here's George Soros, the very scary. Now, this guy is scary. Some of the stuff Soros has said over the years, that'll send you running. April 1st, 2020, George Soros, we're going to have the worst bear market in my lifetime. So all these doomers, all these gloomers, all the people that said the world's coming to an end have been proven wrong. And just remember that, because they all come out of the woodwork. The media parades them out every time the market goes down 1%, 2%, whatever it is. The media parades these people out and says, look at these guys called it. They said the world's coming to an end. Listen to what they say. You got to track them. You got to know what they said the past 5, 10, 15 years, because their report cards, if you actually did what they said, would be a bit, you'd throw them out. I mean, you'd say these guys should be fired. They don't deserve any job on Wall Street, let alone telling people what to do with their money. So do not listen to these people. I'm telling you, this time is coming. A time is coming later this year where the doom and gloomers will be out there, and you are going to be so tempted, like all of us will be, because it's built into human nature. We get scared. It's just part of life. And you're going to be tempted to hit the panic button. Please don't do it. These guys have been wrong. They will be wrong. They'll always be wrong. And they cannot ever align with human nature, the human optimistic American spirit, the American dream that's alive and well. I believe very strongly. I meet people every day, entrepreneurs, who will tell you that fact. Stay in tune with the entrepreneurs. Stay in tune with the people who are optimistic about the long run, not these people who get it wrong all the time. So anyways, that's enough on that. I do want to just make one other point about the doom and gloomers, and I will show you 2023 here. I have all the doomsday predictions. These are all the top firms on Wall Street. These were their predictions of the S&P's price for the end of 2023. So they issue these price estimates in January every year, and then they see, okay, we see how we do. Let's see where we end up in December. So at the beginning of 2023, BMO Harris said the S&P would get to 4,300. JP Morgan said 4,200. Wells Fargo, 4,200. RBC, 4,100. Credit Suisse, 4,000. Goldman, 4,000. HSBC, 4,000. Citi, 4,000. Bank of America, 4,000. UBS, 3,900. Morgan Stanley, 3,900. Barclays, 3,725. Well, guess where the S&P ended last year? At like over 4,700 points. All wrong. Every single one of these reputable, and there's good people at these firms. They're very, very good people. We know a lot of them. We're friends with them. All wrong. Why? Because these are the people, these are the strategists who are selling doom and gloom. Remember what Wall Street, their biggest client, remember who it is. It's hedge funds. Hedge funds are buying most of the Wall Street research, and hedge funds by nature are bearish. They're hedging the market. So what they want to tell you is, okay, the market goes up 10%. We might not be up 10, but we'll be up 5. That rarely happens, but that's their pitch. Then the market goes down 20%. They say, oh, we're going to make you 1% when the market's down 20. That is true. They do that. So their main objective, the main objective of hedge funds is to hedge the downside. So they're always hoping for another 08 and 09. Because of that, the Wall Street research is tailored towards those hedge funds. That's why it's always bearish. Now, no surprise, here's 2024. Going into 2024, it's still early. I get it. It's only going to be March here in a couple of days, but January of 2024. Here were the estimates. Bank of America, 5,000. Barclays, 4,800. BMO Harris, 5,100. Cantor Fitzgerald, 4,400. Citigroup, 5,100. Deutsche Bank, 5,100. I'll keep moving. Goldman Sachs, 5,100. JP Morgan, 4,200. Morgan Stanley, 4,500. UBS, 4,850. And the list goes on. I believe very strongly the herd, all these people, all these doom and gloom strategists are going to be wrong. Now, I'll tell you, at all these firms, there also exists an entirely different class of people called portfolio managers. Every single one of these firms has it. Goldman Sachs has it, Morgan Stanley, Wells Fargo, Merrill Lynch, UBS. They all have people who actually manage money. Those people, if you read their research, people like Michael Sembalist here at JP Morgan, who's been right, Tom Lee, who's been right. There's a whole bunch of other ones out there. Andrew Sliman at Morgan Stanley, he's been right. They all manage money, so they have to produce a track record. If you read their stuff, they're bullish. They're just like us. They're positive. They're optimistic. They say the market's undervalued or fairly valued. So be careful who you listen to. You got to do the research. Stocks are not in a bubble. I believe the bears are wrong. It's never a bubble when people expect it. Stay the course. Don't panic. Don't sell your equities. Don't sell your ownership in America's best companies. If you're in the S&P 500, think about what you have. You've got Microsoft. You've got Apple. You've got Amazon, NVIDIA, Netflix, Facebook, Google, Procter & Gamble, ExxonMobil. The list goes on. JP Morgan. There's all these great companies. Not every one of them is perfect. Not every one of them is going to survive even the next 10 years, but most of them will. And especially the ones at the top who have the best management teams, who have the best balance sheets, that are producing crazy amounts of free cash flow, who do not have a problem with the record high interest rates we're living in right now, will be just fine. And if you hit sell, you're going to give up your equity to people who are patient, people like us, quite frankly, people like the portfolio managers at all these top companies. They are going to buy from the impatient because they had the steely eyes to stay the course. So don't be one of the people in the herd. Don't jump off the cliff. Don't do what your mother told you not to do, which is, hey, if everyone's jumping off the cliff or the bridge, are you going to do it too? And you know the answer should be no. But if you ask all these strategists on Wall Street, they love jumping off the cliff together, holding hands. Why? Because it's more fun to be protected in the herd rather than be the lone voice in the wilderness. Just remember, though, there's plenty of lone voices, and the optimists are not lone voices. There are plenty of people out there who are still bullish, that are still optimistic. There is, again, tons of cash sitting out there. There is so much money ready to scoop up equities, to scoop up companies, to buy commercial real estate, that I believe at the end of the day, we are going to see stocks make record all-time highs. Stay the course. Don't panic. A correction is coming at some point. Don't let it spook you. Use it as an opportunity to buy more. We'll see you at those events in April. This was episode 141, and we'll see you next week for episode 142.